Is Southwest Airlines ready to take off, or is it flying its way into another holiday season meltdown? That is the question I wanted to answer today. And so we will be looking at Southwest Airlines, ticker symbol LUV, to figure out if this low-cost American passenger airline is worth investing in today. Southwest does not publish an investor report for every quarter. Instead, they just do it yearly. So instead, I'm going to skip to its most recent earnings report, which occurred in late August. Now, due to my ad blocker, this headline gets cut off, but it says Southwest Airlines earnings sink on rising fuel and labor expenses. As the title said, the shares lost ground after the carrier reported profit was dragged down by higher fuel and labor costs, as well as planned reductions in capacity growth. AKA Southwest is no longer planning to start as many trips or go to as many cities as they were previously talking about. Their earnings were in line with forecasts at 38 cents per share, but this represents a sinking of 30.3% from a year ago. Compare that to revenues, which rose 4.9%, which was slightly less than forecast, but at least it was an increase. Fuel costs reached $2.78 per gallon, and as I'm sure we all know, planes use tons and tons of fuel. And to add to the pain, costs for salaries, wages, and benefits jumped by 17.5%. And as I said earlier, Southwest now anticipates to boost its capacity by 10 to 12% versus the previous outlook of 14 to 15%, which many people see as a major downside because the company would be taking in less revenue. On the flip side, this does also mean less expenses, but with such a large jump in salaries and wages, I don't think their expenses are going to fall as much as their revenues will. Following earnings, Morningstar cut their fair valuation for Southwest to $19 from $36. Morningstar analysts then go on to say that they don't doubt that Southwest will eventually take market share from its smaller, low-cost competitors, but they believe these gains will be hard-won. Now, by hard-won, you can basically read that there's going to be a pricing war between these low-cost carriers, meaning lower airfare tickets, potentially higher expenses to attract top talent, and lower margins. If you aren't familiar with the low-cost carriers in the United States, their main competitors are Frontier Air, Spirit Air, and Breeze Air. The interesting thing about Southwest, though, is that it's also kind of the nicest of the no-frills models, so they also compete in part against larger, more full-service airlines like Delta, United, and American. This kind of puts the company in an uncomfortable spot where it's not really the lowest low cost, nor is it a full-service airline. So it remains to be seen how consumers will react to Southwest's business plan. On top of all the uncertainty surrounding Southwest's business model and their expenses, there's also the uncertainty of what happened last year around this time. For any of my non-Americans or people who just don't travel during the holidays, essentially Southwest had the largest meltdown in American transportation history, which costed the company over $1 billion and delayed tens of thousands of people. In fact, I kind of underestimated it. It says right here, stranding about 2 million passengers and costing the airlines about $1 billion. Now, essentially, this event began in Denver because there was a large winter storm and they could not de-ice their equipment fast enough and there weren't enough rampers. So essentially, the company was forced to cancel tons and tons of flights. Add on top of the fact that Southwest's computer systems are some of the oldest in the industry, and they couldn't keep track of so many flight attendants and where they were, why they were in different cities, and they couldn't rebuild those flights once the planes and crews were out of position. And that really is the point we want to focus on, is that they were out of position. Southwest does not build its routes like most airline companies do. A regular airline company like Delta or United chooses a city as a hub. So like in Delta's case, one of its main hubs is Atlanta, Georgia, and tons of its flights fly in and out of Atlanta, Georgia. And so it makes logistics for the company way easier. It's called a hub and spoke system. Southwest, on the other hand, uses this kind of spider web system where they just travel in a bunch of lines, and in order for the next flight to take off on time, the previous flight needs to arrive on time, and the crew that is on the previous flight will just hop on to the next flight. And so this only works when your timing is pretty on point and there aren't too many delays. What makes matters worse is that when you use this kind of spiderweb system, maybe your crew gets stuck in a city like Denver, for example, and they were supposed to be in Salt Lake City. And then when they got to Salt Lake City, they were supposed to fly to New York. And now instead of being in New York the next day like they were supposed to be, they're still stuck in Denver and they have no way to get back to New York. That is what happened during that travel season. And that is why Southwest stranded so many passengers, whereas other airlines like Delta or United were able to much more quickly adapt because they could just pull from a large pool of people in their certain hub cities. And so essentially what we saw was that Southwest's computer systems, along with Southwest's business and flight plan, really just failed at the exact same time, creating this mega catastrophe. And so now then the question becomes, if we experience more bad weather, is this going to happen again? I'm certain that there are plenty of travelers out there during the holiday season who remember being stranded by Southwest, and they're going to fly anybody but Southwest this year. I can guarantee it. So within the backdrop of declining revenues, inclining costs, and the specter for another potential holiday shutdown, let's take a look at Southwest's underlying financial numbers and find out if this company presents a good opportunity to buy today. Before we move on though, please take a moment to like this video and subscribe to my channel. It means a ton to me, and I would love to continue bringing these types of videos to you on a regular basis. Thank you so much for your view, and with that, let's get into the numbers. Revenues have grown steadily at about 3.74% per year. And as expected, we did see this massive drop in 2020 following the shutdowns that caused most travel to halt almost overnight. Southwest has rebounded from that very nicely, and they appear to be back on their pre-pandemic growth trajectory. EBITDA, which is an easy way to look at the profitability of a company, is on a major downtrend though. And while the numbers aren't negative like they were in 2020, we still do not see any type of return to pre-pandemic numbers. Operating earnings look much the same, although at least we can say that there's been some growth between 2022 and the trailing 12 months. Gross margins have been declining since 2018, and there is no prospect of that number getting any better considering the costs are rising and competition continues to come into this space. Operating margins tend to be thin in the airline industry, but 1.22% over the trailing 12 months is razor thin. And Southwest's return on assets also look really bad, averaging about 1.5% over the last 2 years and nowhere near their pre-pandemic numbers of 8 to 9%. The company has fairly significantly diluted shareholders, and while the rate of dilution has slowed down a bit, they do continue to do this regularly every year. Cash and short-term investments has been up nicely though since 2018, so it's nice to see that the company is building a safety net. What's less nice is the massive spike in long-term debt that we're seeing in Southwest's balance sheet. I would like to point out that their total long-term debt in the trailing 12 months is less than their cash on hand, so this isn't the most worrisome picture, but this is a trend that we're going to want to watch. Net interest expenses look good, as higher interest rates have led to the trailing 12 months being a positive interest payment to the company instead of an expense. If interest rates were to fall quite quickly though, we will see this number go negative again. Levered free cash flow has dropped pretty substantially, and it has been in a downtrend since 2018. At the very least, I would need to see this number go positive in the near future. Free cash flow per share looks much better, but it is still negative in the trailing 12 months and in the last 2 years. Southwest does pay a dividend, and in general, the company likes to grow its dividend payments. 2019 was the very last year of that dividend growth, and I do agree with this move because the company needed to hoard cash due to the pandemic and a major drop in their business. The company then cut its dividend for 2021, reinstated it in 2022, and in the trailing 12 months, it's at 72 cents, which is the highest it has ever been. To me, this means that management is confident that it's going to be able to get its free cash flow back into positive territory and in increasing territory in the near future. Southwest's annual dividend payout ratio was quite low in 2018 and 2019, which is what we want to see. In the trailing 12 months, we do see a positive payout ratio of 86%, which means that the company is earning enough operating cash in order to pay out this dividend and cover it. But we need to see this number fall in the next year or two quite substantially in order for the dividend to be safe. And finally, with the value chart, we can see there's been major volatility in Southwest's fair price as a result to the company having very mixed earnings since the pandemic. Currently, I have calculated that its fair value is $21 a share versus its current closing price of about $25 per share. So that would suggest that Southwest is currently slightly overvalued. But if we look at the projected CAGR of the company's earnings over the next 5 years, we can see that Yahoo Finance has a projected 29% earnings growth for the next 5 years. This means that their analysts expect quite a significant rebound in Southwest's profitability and its earnings per shares numbers in the near future. And if we use this number to project a fair value into the future, we can see that in 2024, the fair value would be about $27 a share. In 2025, it would be $35 a share. And in 2026, about $45 a share. If these projections are correct, this would represent approximately a 2 times upside in the next 3 years for Southwest. So to summarize what I like about the company, Southwest has a very solid balance sheet. As I said, their long-term debt is actually less than their total cash on hand, which makes them a pretty safe company to invest in. This is especially the case when we compare them to other airlines in the industry, which have way worse balance sheets on average. Secondly, low-cost tickets are increasingly popular to consumers. This shift makes sense, and I do expect that to continue to be a trend. And finally, we are seeing a shift in consumer priorities towards experiences rather than owning items. This, I think, is a mindset that more and more people are starting to embrace. And so travel will be a bigger and bigger part of how people spend their free money and their free time. And so I think this could provide a good long-term secular growth model for Southwest as a company. But what I do not like about the company is, first and foremost, those margins are still being squeezed. It doesn't matter how many customers Southwest can fly every year if they cannot maintain positive margins on their business. Secondly, those free cash flow numbers remain negative. And while I do think these numbers can go positive if Southwest remains on the rebound trajectory that many analysts expect it to be on, I'm not going to give Southwest the benefit of the doubt until I see that well and truly these free cash flow numbers have gone back into the positive. And finally, the passenger airline industry is highly cyclical and very, very susceptible to economic downturns. Let's face it, most of us when we travel, it's really great to be able to do it, but if we have to cut our budget, then travel and vacations are one of the first things that get cut. And so if regular people start having trouble making payments, they start losing jobs, things like that, Southwest and all other airlines and many travel and tourism-based companies are going to feel that pain almost immediately. And while when consumers have money, there's this major boom, when they do not have money, there is a major crash. And that is something that you need to be aware of when you're investing in airline companies. And this final point is the reason why I believe that now is not the right time to invest in Southwest or in airlines in general. And so for me, what I am doing is I am holding off on investing in airline companies until I see a major recession that has crushed everything and, prices are down 60, 70, 80, 90%. And from there, then I will analyze the airlines a little bit more closely and find the companies that I think have the best prospects for turning around from both a balance sheet perspective, a customer experience perspective. Until a major recession rolls around, I think there are better investment options out there. But that is just my choice personally, and you are free to make whatever decision you would like. So with that, I hope you enjoyed this content. I hope you learned something new. And before you go, if you could please double check that you smashed that like button, I would greatly appreciate that. And I hope you all have a great day.